A mortgage is essentially a very large loan you get from a bank or lender, specifically to help you buy a home. It's not just any loan, it's designed for one of the biggest purchases you'll ever make in your life. When you want to own a house but don't have hundreds of thousands of dollars sitting in your bank account, a mortgage steps in to bridge that gap. Most people simply don't have enough cash to pay for a house outright, and that's perfectly normal. Houses are expensive, and saving up the full amount would take most people decades. That's why mortgages exist, to make homeownership possible for regular people, not just the super wealthy. When you get a mortgage, you're entering into a legal contract. You promise to pay the bank back, usually in monthly installments over a set period of time. The house you're buying acts as collateral, which means if you don't keep up your end of the bargain, the bank has the right to take the house back. If you stop making payments, the bank can take your house through a process called foreclosure. This is a serious consequence, and it's why understanding your mortgage is so important. Foreclosure can damage your credit and make it much harder to buy another home in the future. Mortgages are long-term commitments, often lasting 15, 20, or even 30 years. That means you'll be making payments for a big chunk of your adult life. It's not something to rush into or take lightly. Think of it like borrowing money for a car, but on a much larger scale. The stakes are higher, the amounts are bigger, and the consequences of missing payments are much more serious. The mortgage agreement spells out exactly how you'll pay back the money, how much you owe each month, how long you'll be paying, and what happens if you miss a payment. It's all written down, so there are no surprises. Remember, the bank isn't your friend, it's a business. Their goal is to make money by lending you money, and they do that by charging you interest on your loan. The longer you take to pay it back, the more interest you'll pay over time. That's why it's your job to be an informed consumer. Read every part of your mortgage agreement, ask questions, and make sure you understand the rules before you sign anything. Don't be afraid to get help from a professional if you need it. Always remember, a mortgage is a secured loan, which means your home is on the line. If you default, you could lose not just your house, but also your investment and your sense of security. Respect the process. This is likely the biggest financial decision you'll ever make. Take your time, do your research, and don't let anyone rush you. If you take it seriously and make smart choices, you'll be on the path to financial power and the security of owning your own home. Most people dream of owning a home, but with prices in the hundreds of thousands, few have that much cash. Mortgages make home ownership possible for regular people by bridging the gap between what you have and what you need. Without mortgages, only the wealthy could buy homes, the rest would rent forever. A mortgage lets you buy now and pay over time, building equity as you go. It's a tool for stability, wealth building, and investing in your future. Saving up the full price would take decades, and by then, prices would likely be even higher. Mortgages let you lock in today's price and pay with future earnings. Used wisely, they're a powerful tool. Used carelessly, they can cause harm. The goal: use your mortgage to build a better life, not let it control you. Make the dream a reality, responsibly. The mortgage rate is the price you pay to borrow money. The interest rate. It's the percentage the lender charges you each year for the privilege of using their money to buy your home. This rate is one of the most important numbers in your entire home buying journey, because it directly affects how much you'll pay every month and over the life of your loan. Even a small rate, like 6.5%, adds up over 30 years. You could pay more in interest than the original loan. For example, on a $300,000 mortgage, a 6.5% rate could mean paying over $380,000 in interest alone by the time you're done. That's more than the house itself. The longer your loan, the more those interest charges pile up. A lower rate means you pay less overall, a higher rate means you pay more. Even a difference of 0.5% can change your monthly payment by hundreds of dollars, and your total cost by tens of thousands. That's why it's so important to understand how rates work and what affects them. Think of it as a rental fee for money, charged annually on what you still owe. Each year, you're paying the bank for the money you haven't paid back yet. The more you owe, the more interest you pay. As you pay down your loan, the interest portion shrinks, and more of your payment goes toward the actual loan balance. Early on, most of your payment goes to interest, not the loan balance. This is called amortization. In the first years, it can feel like you're barely making a dent in what you owe, because so much is going to interest. But over time, as your balance drops, the interest shrinks and you start paying off the loan faster. That's why even a small difference in rate can save, or cost, you tens of thousands. Over decades, a lower rate can mean keeping a huge pile of money in your pocket, instead of handing it over to the bank. It's one of the biggest ways to control your long-term costs. Your top goal: get the lowest rate you can qualify for. This isn't just about bragging rights, it's about real savings, every single month, for years to come. The lower your rate, the more affordable your home will be, and the more financial freedom you'll have. Shop around, compare offers, and don't settle for the first rate you see. Different lenders offer different rates, and sometimes just asking for a better deal can get you a lower one. Take your time, do your homework, and make lenders compete for your business. Even a fraction of a percent matters. That tiny difference can add up to thousands of dollars over the life of your loan. Don't overlook the small print. Every decimal point counts. The mortgage rate is the key to how affordable your home will be. It unlocks the door to your financial future, shaping your budget and your ability to build wealth through homeownership. Pay close attention, it's the number that matters most. Understanding your mortgage rate puts you in control, helping you make the smartest, most confident decision for your future. When you get a mortgage, one of the first big decisions you'll face is choosing between a fixed-rate mortgage and an adjustable-rate mortgage, often called an ARM. This choice can have a huge impact on your monthly payments, your long-term financial security, and even your peace of mind as a homeowner. A fixed-rate mortgage locks in your interest rate for the entire life of the loan, whether it's 15, 20, or 30 years. That means your monthly payment for principal and interest will never change, no matter what happens in the broader economy or with interest rates elsewhere. This gives you predictability and stability, making it the safest and most popular choice for most people. You'll always know exactly what you owe each month, which makes budgeting much easier and helps you avoid surprises. On the other hand, an adjustable rate mortgage, or ARM, starts with a lower teaser interest rate for a set period, often 3, 5, or 7 years. After that, the rate can adjust up or down, usually once a year, based on changes in a specific financial index. While that initial lower rate can be tempting, and may save you money at first, it comes with a big risk. If interest rates rise in the future, your monthly payment can jump, sometimes by hundreds of dollars or even more, depending on the size of your loan. This risk has caused many homeowners trouble in the past, especially when rates have risen quickly or unexpectedly. Some people have found themselves unable to afford their new higher payments, leading to financial stress or even foreclosure. ARMs can make sense if you're certain you'll move or refinance before the rate adjusts, such as if you're only planning to stay in the home for a few years. But for most people, the uncertainty just isn't worth the risk. Don't be fooled by a low initial payment if you can't handle future increases. It's important to look beyond the first few years and consider what could happen if rates go up and your payment rises sharply. Before choosing, think carefully about your risk tolerance, your long-term plans, and your ability to handle changes in your monthly budget. Ask yourself, can I afford higher payments if rates rise? How long do I plan to stay in this home? What's more important to me, saving money now or having peace of mind for years to come? For most families, a fixed-rate mortgage means peace of mind. It's about choosing stability over uncertainty and protecting your home and your finances from unexpected changes. The right mortgage type can protect your financial future and help you sleep better at night. Take your time, weigh your options, and make your choice wisely. Your home and your financial well-being depend on it. Why do some people get better mortgage rates than others? It comes down to risk. The biggest factor is your credit score. A high score means lower risk and better rates. Lenders also look at your down payment. More money down means less risk for them. A down payment of 20% or more can get you a better rate and help you avoid extra fees like PMI. Your debt-to-income ratio, DTI, matters too. Banks want to see you can handle your payments. Before applying, check your credit, pay down debts, and save as much as you can. The 3 pillars: high credit score, solid down payment, low DTI. These get you the best rate and save you money over the life of your loan. Prepare before you apply. Don't leave money on the table. The better your financial picture, the better your mortgage deal. Even if you do everything right, mortgage rates can change daily. Rates are tied to big economic forces, especially the Federal Reserve, which influences rates by raising or lowering its own. When the Fed raises rates to fight inflation, mortgage rates usually go up. When the Fed lowers rates, mortgage rates tend to drop. Inflation itself pushes rates higher as lenders want to protect their profits. The overall economy matters too. Strong economies push rates up, weak ones pull them down. Watch economic news, especially about inflation and jobs, for clues on where rates are headed. You can't control these forces, but you can time your application wisely. Understanding the market helps you make smarter decisions. Let's see how rates affect your wallet. On a $300,000 loan at 6%, your monthly payment is about $1,799. At 7%, it jumps to $1,996. A $200 difference every month. Over 30 years, that's $71,000 more paid in interest. That extra money could go to savings, college, or paying off your loan faster. Instead, it goes to the bank. Higher rates also mean you can afford less house for the same monthly payment. When rates rise, your purchasing power drops. This is why the housing market slows when rates go up. Know the math. A small rate change has a huge impact. Focus on the long-term cost, not just the monthly payment. Understanding this gives you real financial power. Knowledge is your best protection when buying a home. Don't assume lenders or agents have your best interests at heart. They're there to make a sale. Understanding mortgage rates puts you in control. You'll know to check your credit, save for a down payment, and shop around for the best deal. You'll ask smarter questions and avoid risky loan products. This confidence lets you negotiate from strength and avoid costly mistakes. Even a small rate reduction can save you tens of thousands of dollars. That's money for your future, not the bank's. Learning this before you buy is the best investment you can make. Take the time, your financial future depends on it. As you start your home buying journey, remember a few key things. Get pre-approved before house hunting. It shows sellers you're serious and tells you what you can really afford. Don't fall in love with a house outside your budget. Watch out for fees. Compare not just rates, but all closing costs on your loan estimates. Sometimes a lower rate comes with higher fees, making it a worse deal. Lock in your rate at the right time. Once you have an accepted offer, talk to your lender about when to lock. Don't gamble on rates dropping, protect yourself from surprises. Remember, a mortgage is a marathon, not a sprint. Choose a payment you can comfortably afford, with room for life surprises. Don't stretch your budget to the limit. Home ownership should bring peace, not stress. Be smart, be prepared, and stay in control. You've got this.